I want to start with a question that every investor, every retiree, and every person who owns a dollar-denominated savings account needs to be able to answer right now. What does the Federal Reserve do when the economy is simultaneously contracting and inflating, when GDP growth has collapsed to 0.7% and inflation is running at 3.1%, above the Fed's own 2% target, when unemployment is rising and oil is above $100 per barrel, when cutting rates would pour fuel on an inflation fire and raising rates would accelerate an economic collapse that is already visibly underway? What does the institution that controls the world's reserve currency do when every tool it has makes one problem worse while trying to solve the other? I have been watching central banks navigate impossible configurations for 40 years. And what I know from that experience is this: when the Federal Reserve is trapped between inflation and recession simultaneously, it does not solve the problem. It manages the timeline of an outcome that has already been determined by the arithmetic. And the outcome that the arithmetic of 2026 has already determined is the most consequential development for gold, for silver, for every savings account, and for every retirement portfolio in the developed world. Let me show you exactly why. The word stagflation was not invented in 2026. It was invented in the 1970s to describe precisely what the United States economy is experiencing today: stagnation plus inflation, a simultaneous combination that conventional monetary policy was never designed to handle. The reason conventional monetary policy was never designed for stagflation is that the two problems require opposite treatments. Recession requires lower interest rates to stimulate borrowing, investment, and economic activity. Inflation requires higher interest rates to reduce borrowing, cool spending, and bring price growth back toward the central bank's target. When you have both problems at once, cutting rates treats the recession and worsens the inflation. Raising rates treats the inflation and accelerates the recession. And holding rates steady, which is what the Federal Reserve has been doing, treats neither problem while the arithmetic of $39 trillion in debt at current rates continues to compound in the background. This is not a theoretical scenario. Every major recession indicator is currently flashing simultaneously. Real GDP grew just 0.7% in the fourth quarter of 2025, annualized, less than half the prior estimate of 1.4%. The ISM manufacturing PMI has remained in contraction territory below 50 for 9 consecutive months. The Conference Board Consumer Confidence Index has been trending lower since early 2026, with expectations for future conditions falling faster than present conditions, a pattern that has historically preceded recessions by 6 to 12 months. Initial jobless claims have been rising steadily since the fourth quarter of 2025. The unemployment rate stands at 4.4% and is moving higher. Every one of those numbers is a recession signal, and simultaneously, inflation is running at 3.1%, oil is above $100 per barrel, and the Federal Reserve's own revised inflation forecast for 2026 moved higher at its March meeting. That is stagflation, not a theoretical risk, a measured reality. Now, I want to show you why the 1970s parallel, which every financial commentator is making right now, is correct in its diagnosis and incomplete in its prescription. Because the resolution that ended the 1970s stagflation was brutal, specific, and structurally impossible to replicate in 2026. In 1979, Federal Reserve Chair Paul Volcker made a decision that no central banker has had to make since, and that no central banker in 2026 has the arithmetic to make again. He raised the federal funds rate to 20%, not 2%, not 5%, 20%. The prime lending rate hit 21.5%. Mortgage rates reached 18%. The United States economy was deliberately pushed into a severe recession to break the inflationary psychology that had embedded itself into wage negotiations, into corporate pricing decisions, into the expectations of every economic actor in the country. It worked. Inflation came down. The economy eventually recovered. And The 1980s bull market in stocks and bonds that followed was built on the foundation that Volcker's brutal medicine had created. But here is the number that makes the Volcker solution structurally impossible in 2026. When Volcker raised rates to 20% in 1979 and 1980, the United States national debt was approximately $900 billion. The annual interest cost of that debt at 20% rates was approximately $180 billion, a painful number, a survivable number. The United States national debt today is $39 trillion. The annual interest cost of that debt at 20% rates would be $7.8 trillion. $7.8 trillion. The entire federal discretionary budget in 2026 is approximately $1.7 trillion. The interest cost alone at Volcker rates would be 4.5 times the entire discretionary budget. The arithmetic does not permit a Volcker solution. The tool that broke stagflation in 1980 cannot be used in 2026 without creating a fiscal crisis that would be orders of magnitude more severe than the inflation it was deployed to prevent. This is not a political argument. It is arithmetic. And arithmetic does not negotiate. Let me show you the specific mechanism by which the stagflation trap operates on gold, because this is where the analysis that most financial media provides is incomplete in the most consequential way. The conventional wisdom says that rising inflation is good for gold, and rising recession risk is good for gold, and therefore stagflation, which combines both, should be doubly good for gold. That is correct in the long run and misleading in the short run. And the difference between the short run and the long run in this specific configuration is where most investors make their most expensive mistake. In the short run, stagflation creates a specific problem for gold. The oil shock that is driving the inflationary component of stagflation simultaneously strengthens the dollar through the petrodollar mechanism and prevents the Federal Reserve from cutting rates, which keeps real yields elevated. A strong dollar and elevated real yields are the two mechanical headwinds that suppress gold in the short term. This is exactly the configuration that has been operating since the Iran war began. Gold hit an all-time high of $5,596 per ounce in January 2026. By late March, it had fallen to $4,400, a correction of more than 20%, occurring simultaneously with oil above $100 and bombs falling in the Middle East. The short-run mechanism suppressed gold while the long-run structural case was becoming more powerful than at any previous point in this cycle. But here is what changes the short run into the long run, and why the stagflation trap specifically accelerates that transition. The stagflation trap means the Federal Reserve cannot normalize the situation through conventional tools. It cannot raise rates to Volcker levels because the debt arithmetic prohibits it. It cannot cut rates because inflation is running above target and oil is above $100. It cannot hold rates indefinitely because the economic deterioration that 0.7% GDP growth represents will eventually force a policy response. Every path the Federal Reserve can take in a stagflationary environment eventually leads to the same destination: monetary accommodation of the inflation that the fiscal arithmetic makes unavoidable. And monetary accommodation of inflation in every historical instance has a name. It is called debasement. And gold is the asset that prices debasement before the central bank calls it something else. Now, let me walk you through the 4 specific economic signals I am watching most closely right now to track the progression of the stagflation trap, because understanding where we are in the sequence changes everything about how you interpret the daily price movements that financial media uses to generate confusion rather than clarity. The first signal is the spread between the core PCE inflation reading and real GDP growth. Core PCE inflation is currently at 3.1%. Real GDP growth is at 0.7%. The spread between those two numbers is 2.4 percentage points of inflation running above economic growth. In 1974, during the first OPEC oil shock, That spread reached approximately 4 percentage points before the Federal Reserve was forced to begin the policy accommodation that eventually embedded the inflation of the late 1970s. We are not yet at 4 percentage points in 2026. We are at 2.4. But the trajectory, with oil above $100, continuing to push energy costs into core prices, is moving toward that threshold, not away from it. The second signal is the unemployment rate relative to the natural rate of unemployment. The unemployment rate is currently 4.4% and rising. The Federal Reserve's own estimate of the natural rate of unemployment, the rate below which inflation accelerates, is approximately 4%. We have crossed that threshold. Unemployment is above the natural rate and still rising. That means the labor market is deteriorating in a way that would, in a normal inflationary environment, give the Federal Reserve cover to begin cutting rates. But this is not a normal inflationary environment. Oil above $100 means that cutting rates to support the labor market simultaneously risks entrenching the inflationary impulse from energy prices into wages and services inflation. The Fed is caught exactly between these two signals. The third signal is the manufacturing PMI, which has been below 50 for 9 consecutive months. 9 months of continuous contraction in manufacturing is not a soft patch. It is a structural deterioration of the productive capacity that generates the real economic output that makes debt serviceable. When manufacturing contracts for 9 consecutive months while inflation is running above target, the fiscal arithmetic of debt service against a shrinking tax base begins to deteriorate in ways that rating agencies eventually document. Moody's documented exactly that trajectory in May 2025. The fourth signal is the Conference Board Leading Economic Index, which has been declining for 17 consecutive months. 17 consecutive monthly declines in the leading economic index is one of the most reliable recession predictors in the historical record. It has preceded every major American recession since the index was created. It has been declining for 17 months. The stagflation trap is not approaching. It has arrived. The question is not whether the Federal Reserve will be forced to choose between its inflation mandate and its employment mandate. The question is which mandate it sacrifices first. And the answer to that question, given the fiscal arithmetic I have described, is that it will sacrifice the inflation mandate. Not immediately, not publicly, but the path of least political and fiscal resistance in a democracy carrying $39 trillion in debt with a central bank that recorded $245 billion in losses on its own balance sheet is always toward accommodation, always toward the policy that makes the debt more manageable in nominal terms, even as it erodes purchasing power in real terms. Gold prices that accommodation before the central bank admits it is happening. That is not a prediction. That is a description of what gold has done in every stagflationary episode in recorded monetary history. Let me close with the historical record on gold's performance in stagflationary environments, because the data is more precise and more actionable than any forecast I can offer. In the stagflation of 1973 to 1974, gold rose approximately 72% over 18 months as the first oil shock embedded itself into the monetary system. In the stagflation of 1978 to 1980, gold rose from approximately $180 per ounce to $850 per ounce, a move of more than 370% over 24 months, not because investors panicked, because the arithmetic of a monetary system simultaneously dealing with inflation it could not control and an economy it could not stimulate through conventional rate cuts made the debasement of the dollar mathematically inevitable. And gold, which has no balance sheet to obscure, no press conference to manage, and no political mandate to balance, priced that inevitability before the Federal Reserve acknowledged it. The 2026 stagflation setup is structurally more extreme than 1973 and structurally more constrained in its resolution than 1979. More extreme because the debt load that prevents a Volcker solution is 80 times larger in absolute terms than it was when Volcker deployed it. More constrained because the Federal Reserve of 2026 has already begun the quiet monetary accommodation that the arithmetic requires: $40 billion per month in Treasury purchases under a name that is not quantitative easing, a $245 billion balance sheet loss called a deferred asset, a policy rate held steady while core inflation runs 110 basis points above target. The accommodation is already happening. The market has not yet fully priced it. The investors who understand what stagflation means for the Federal Reserve's policy options, who understand what the policy options mean for the long-term purchasing power of dollar-denominated assets, and who understand what history says gold does when a central bank is forced to accommodate inflation it cannot conventionally fight. Those investors are not confused by the short-term gold correction that the oil shock created. They are watching the two indicators that tell you when the short-term suppression mechanism exhausts itself: the DXY below 97, the 10-year yield below 3.5%. When both of those levels are reached, the mechanical headwinds against gold reverse simultaneously against the backdrop of a stagflationary environment that has made monetary accommodation inevitable. That reversal, when it comes, will not be gradual. Structural repricing events in precious metals markets never are. Most investors are watching the daily gold price and the daily oil headline. They are watching the wrong things. The stagflation trap has already closed around the Federal Reserve. Now you understand what that means.